Ryan Lamont is an advisor to the board of directors at Securrency Capital. Ryan, just unpacking a little bit of what Mohamed El-Erian had to say to the market, a very powerful statement, I think, from him in regards to where the neutral rate is. He said it was comical if the Fed, the notion that we are at a neutral rate is comical, and they may need to break something to get inflation under control. Where is the upper bandwidth of neutral for you, given the jobs data, wages data that you had on Friday?
Good morning, Manus. Good to be back again. Yes, indeed, and this is something we discussed since a few months on your show. Neutral rate should be much higher than it is today. Inflation is just going up. I wouldn't be surprised to see it even at 10%. So neutral rate is anywhere between 4 to 4.5%, given how strong the U.S. economy is at the moment.
All right, let's build on that a little bit in terms of what we can expect over the next couple of days as we prepare and react to the inflation numbers. Brian, we put this chart together, GTV Go. Actually, it's not a chart, it is a quote from Eric Robertson from Standard Chartered. Here's what stood out to him. He writes, "We turned tactically neutral on risky assets post-FOMC to get out of the way of choppy and illiquid summer markets. They believe risks are still elevated. The low levels of equity vol may be the calm before the storm." Agree or disagree?
100%. And I said it again with you on the show, Yusuf. The VIX is showing a very, very low level. For us, it is a bear market. It's a very orderly bear market with the VIX where it is today. However, things can get choppy and should get choppy. I'll say it again, inflation cannot be controlled unless stock markets drop and real estate markets drop in the US. It is that wealth effect that is boosting absolutely everything, boosting consumption, boosting all assets. So these two have to drop before things get better on the inflation side.
Well, we've had this reappraisal of risk in July, haven't we, in the equity market? But if you look under the hood, Ryan, and we put this in the GTV library, which is, I would say, the propulsion of the shorts. Sell everything in equity, sell everything in bonds. In other words, these net shorts are rising quite aggressively. Do you think we're missing something here? Do you think the market is subliminally building much bigger short positions than we think?
Well, this is when contrarians step in and tell you where there's so many shorts at the moment that this is subduing any drop in the markets, because any drop in the market would trigger a short covering. So this is basically creating another virtual Fed put that is stopping the markets from dropping. So yes, indeed, many people are negative. The big institutions are preparing for the worst, as you mentioned. So yes, it's a big conundrum we are in the markets at the moment. I've never seen this before.
I mean, we just got a headline crossing the Bloomberg, a red headline. This is on China extending military drills near Taiwan on Monday. They were expected to come to a close after the weekend, late Sunday. Now it appears the Chinese government has decided to extend these U.S. equity futures just a little bit below the flat line at the moment on the S&P 500 mini. Ryan, to what extent is headline risk going to come back into play, both around what is happening with China and Taiwan and with Russia and Ukraine on the others we get to the back end of the year?
Absolutely. Yusuf, what's happening between China and Taiwan is very, very dangerous. Through the Taiwan Strait, 88% of the large container ships go through. So this is really one of the most important shipping lanes that we have out there. Any disruption there will bring us back into huge supply chain disruptions. So inflation can spike again even more. And I don't think that risky assets are factoring in sufficiently this potential disruption there and this geopolitical tension that is happening between China and Taiwan.
Tell me this, with the China trade surplus this morning, exports up 18%, so you're looking at a record trade surplus. Bull or bear for the world, given the next meeting between Biden and Xi is slated? It could become a little bit more contentious with data like this.
Well, more bear, I would say, because data is so good, we should see it soften. We are relatively at a peak, so we should start seeing things deteriorating a little bit. So that trade surplus is just absolutely tremendous. Things should start dropping from there.
Ryan, we'll leave it there. Straight to the point. We love it. Thank you for sharing some of the ideas. That's Ryan Lemand. He's the advisor to the board of directors of Securrency Capital.